Get Rich Education is brought to you by Valhalla Wealth and Ridge Lending Group.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 164. Hi, I'm Keith Weinhold. What if I introduced you to someone today that has money and is willing to put that capital into your real estate deal or other business deal right now if it were the right match for him? And what if that person also happened to be a rich dad advisor himself? Do you think the fact that he invested with you would attract other money to your deal alone? Well, that is exactly who we're going to be talking to in a few minutes here on the show. He's actually been on the other side of the transaction because he's a master of raising capital himself, and he's going to give you some tips about how to go about doing that yourself if you would ever want to do that. He's even authored a book in the Rich Dad Advisor series called The Art of Raising Capital, and I believe he's the only Rich Dad Advisor based outside the United States. He's based in Canada, and interestingly, he's also going to be hosting a cash flow board game. Not just any cash flow board game, but he will, in fact, be hosting the world's biggest cash flow board game with Robert Kiyosaki on December 9th and 10th. That's something interesting for you to look out for. Before we meet him, let me just tell you about some real estate investing problems that I've had recently as an active investor myself. We know that real estate investing is where the real wealth is built, but we still have these problems, these bumps along the way, and those bumps are exactly where we get the lessons. And we can't let these short-term setbacks affect our long-term wealth building picture. In one of my apartment buildings, I recently just had a bad tenant that had to be evicted. It just happens every once in a great while. Of course, I do have a property manager taking care of everything. This tenant couldn't pay the rent on time. They left people that were not on the lease stay there in the unit a little bit more than just occasionally. On the way out, they left a few holes in the walls. They left a bunch of gunk inside the oven. Just the kind of classless tenant all around. Well, when that unit was vacated, there were also some pinhole leaks in the copper pipe inside the wall between the kitchen and the bathroom. The property manager didn't know how the tenant could have made that happen. Possibly that's just a coincidence. I don't know. Water damage like that from the leaky pipe, that's something that my landlord's insurance policy appeared to exclude. Sometimes things just happen. I think it was about $12,000 in total that I put into that 2-bed, 1-bath apartment unit to get it back up to speed again. And we actually added some new kitchen cabinets and made it nicer than it was before the bad tenant even moved in. So the damage wasn't even $12,000. Plus, we added some nice touches like vinyl plank flooring where cheap carpet had existed before. So I don't know, maybe it was only half that $12,000 in actual damage. And I have had hundreds of tenants throughout my life, and sometimes things just happen, and that one wasn't really a big deal to me. But now that right there, see, if that happened to a brand new real estate investor, they might get spooked and they might get discouraged. And you've got to remember that real estate investing is a long-term game. It's sort of a game of attrition and avoiding mistakes. Those that buy at least somewhat right when they buy, and they have an above average manager, are going to greatly enhance their prospects for building wealth over their life. So whatever, I had a longer than usual vacancy in that unit during eviction and renovations. And by the way, as an investor, when you learn that you're going to have an upcoming vacancy, set the tone with your property manager. Let them know what to expect. Ask them right then how soon they're going to be advertising the unit. Of course, they can advertise it while your outgoing tenant is still in the unit before they've left. We want to limit your vacancy between tenant turns and make sure your manager just kind of knows that you're on your toes, and ask them questions like that from time to time. Just hit reply in the email. It's one sentence. I also noticed on my property manager statement recently from the same manager that there was an invoice in there where their flooring contractor hit me with a $200 trip charge that should not have been charged to me. Apparently, there was some miscommunication between my manager and their flooring contractor, and they had the flooring contractor crew show up at the unit before it was even ready for the new flooring. Well, the crew had to leave and then show up again later to actually do their work when it was ready. Well, that was their fault. I should not have been charged that $200. I brought it up to the manager after reading my statement, and they went ahead and reversed it. So the lesson there is just take a few minutes at the end of each month and read your management statement. It's pretty easy to do. You know, one of the most interesting real estate problems that I guess I had overall this year, that occurred in a different one of my apartment buildings. This one's a 9-plex that I own, and it's in a cold climate, and temperatures have gotten chilly as we move toward winter. Well, homeless people were squatting inside the laundry room of my building, sleeping inside where it was warm. A couple or maybe 3 of them had their bedrolls sprawled out in both the laundry room and these sort of storage areas adjoining the laundry room. And this 9-plex, it's not in a bad area. It's in a fairly decent area, but it's just 5 blocks away from this kind of main arterial highway in this city. And see, the apartment, it's in that fairly good area where there's just a whole bunch of other single-family homes around. There aren't many apartment buildings around. So since this was an apartment building, it offered one of the few common area heated spaces around in that area. So the manager dealt with the homeless people pretty promptly. But, you know, the thing is it all came down to getting the main building entrance door resecured with an electronic keypad so that those people could not get back in again. But see, the real concern about homeless people just being there for a short period of time, it was, here's the question. Do the existing rent-paying tenants, do they feel safe? Or now that this happened, do those existing tenants feel threatened? Because you don't want any flight out from those existing rent-paying tenants because now they think that your building is unsafe or something. So, you know, just like any business operates, you got to remember it is easier to retain existing customers or tenants in this case than it is to go out and find new ones. So that was really up to the manager of doing a good job of communicating with those existing tenants, conveying trust, demonstrating to those existing tenants that the building was secured with this new electronic lock and keypad, and go ahead and individually show that to them to make them feel safe. And the manager did that well. So I guess my point with bringing up problems to you once in a while is that it demonstrates that real estate is not a perfect investment. Nothing's perfect. But real estate investing is just better than anything else. And we're going to talk about that some more today. And by the way, none of those situations mentioned happen to be the work of any of our fine management teams at greturnkey.com. They're the website where you find the best properties and best providers in investor advantage markets. And gosh, you know, another really important takeaway here is just the fact that I do have a property manager. I was not managing myself. I respect myself and my time more than that. So therefore, I did not get emotionally attached to any situation. I had that buffer there, so I didn't lose much of my time. Well, let's talk to today's guest. We're going to talk about real estate investing and then a little bit about raising capital for deals. Today's guest is based in Canada. For nearly a decade and a half, he has spoken to hundreds of thousands of people across North America, Europe, and Latin America about how to become financially independent. He went from an average middle-class upbringing to raising hundreds of millions of dollars in investor capital. Today, he owns nearly 5,000 properties himself, millions of dollars in energy assets, and interestingly, he has acquired 2 cruise ship terminals in the Caribbean and also launched a company called Black Rifle Coffee Company. And you know what's even more interesting is all of this was accomplished by educating himself on how to do it and then taking action. And boy, right there's an example of the old mantra, formal education will make you a living, self-education will make you a fortune. Well, he wrote a book called The Art of Raising Capital, and it's pretty difficult to find a better expert anywhere on the art of raising capital from investors. Welcome to Get Rich Education, Risk Stat Advisor, Darren Weeks.
Hey, Keith, thanks very much. I appreciate the opportunity to speak to you and your listeners.
It's great to have you here. So just tell us a bit about how you got into an interest in real estate and entrepreneurship and how you became a Rich Stat Advisor.
Well, it starts back when I was 6 years old, and I won't bore the listeners too much, but at 6 years old, my uncle gave me 3 quarters because I helped him move. And actually, Keith, it's funny because he was probably the worst tenant you could ever imagine, and that's why I was helping him move. So he gave me 3 quarters for helping him a little bit. And at that moment, I went home and put those quarters on my mattress in my bed before I went to sleep. And I said, you know what? I'm going to be rich. So ever since that day, I've always liked money, and I've done things to, to learn how to acquire money. And that's how it started. And where it went from there was I did really unique things. When I was 10, I was buying mutual funds. When I was in grade 10, I was buying silver bars. And my first property I bought while I was a university student in 1990, and I still own that property today. Around 2001 is when I read Rich Dad, Poor Dad, and that was kind of a game changer for me. That allowed me to go from, I would say, the minor leagues to the big leagues, and I really started to take a lot more educational classes, financial literacy classes, specifically with Robert Kiyosaki. So that's generally how I got started and my mindset when I was younger. And meeting Robert, again, was a huge game changer. I just started to think a lot bigger after that.
Yeah, some striking similarities there. 2001, that's about the year that I first read Rich Dad, Poor Dad. And when I was a kid, I sure didn't know about real estate investing yet, but I knew that they put these stock quotes in the newspaper, so I would transfer those quotes onto a handwritten piece of paper and go ahead and track stocks that way, even though I wasn't even invested in the stocks and I didn't have the money to do that. So tell us about the road to becoming a Rich Dad Advisor and getting around Robert Kiyosaki.
Well, you know, Robert's been the most generous guy anybody could ever imagine. And I was very fortunate that I read the book and then I took action, and I took a program in 2001 called the Facilitation Program. And it allowed me for, a $15,000 fee to be able to get educated and then start to play the cash flow game. So I took that course and I thought, okay, I'm going to launch a business around the cash flow game and teach the cash flow principles in Canada, because things are a little different in Canada than they are in, for instance, the United States. So I thought I'd come back to Canada, play the game. And honestly, Keith, I thought it'd be a great way to find investors by meeting people, playing the cash flow game.
Yeah.
But what I realized was it's very difficult to get people into a seminar type format. And only 4 people showed up at my very first event in 2001. So I was a little heartbroken. I thought it's going to take forever to make this $15,000 investment back that I made. But you know what? I kept persevering. And my next event had 8 people, then 10, then 15. And a couple of years later, I had the world's largest cash flow game. Over 800 people play the game. And since then, I've spoken to hundreds of thousands of people all about financial education. And really, it's the cash flow game that changed my life.
That's interesting. And a $15,000 fee, some people look at that and was like, oh, that's so expensive. That's such an advanced price for learning something. That's so much to pay for education. You know what I often say about education, Darren, and paying for education is whatever you pay, you either overpay or you underpay based on you and based on the action that you take. You know, a person can actually underpay for a $1 million seminar if they take action that results in $4.5 million. So what's overpaying or underpaying? It has less to do with the price, and it has more to do with you, the student, and how you act on it.
That's awesome. I'm going to steal that if you don't mind, Keith. That's a really good analogy. And I guess I underpaid dramatically for that $15,000 2-day event.
Quite an ROI there on that one. Yeah, that ROI might be better than a real estate ROI. So, a lot of this comes down to investing in real estate. When you've got some extra dollars and what you do with it, I think that comes from maybe transitioning away from the mindset maybe that at a point we had as children, Darren, when we were thinking about investing in stocks, just because that's what was fed to us, just because that was the popular thing. That's what most people are doing. But you soon learn if you want to have success, you have to do what most people aren't doing. Most people aren't investing in real estate. I think a lot of lay people, Darren, have heard that real estate's made more ordinary people wealthy than anything else, but they just don't know how. One reason that people don't create wealth through real estate is, you know what? They're in a geography that just does not have what I would call investor advantage metrics. They happen to live in an area that doesn't have a good intrinsic ratio of rent income to purchase price. And that ratio of rent income to purchase price is so important in profitability, but a lot of real estate investors don't even know about that. And I think once one learns about that, they learn that, well, in order to get the best returns, they need to invest in a different geography. But some people have a real holdup with that. So kind of what are some of your thoughts or tips or techniques about becoming comfortable with investing in a geography other than your own backyard? Because that's not where the deals typically are.
Well, again, I didn't understand that until I was into real estate for about 6 years. So I bought my first property in 1990. I bought maybe 10 more by the time it was 1996. And then my brother actually told me he bought a property, and I forget the city, but it was not where we lived. You know, I live in Edmonton. Let's say it was Calgary. And I said to him, are you crazy? Like, how are you going to manage this property so far away? And he goes, I don't have to manage it. The company that I bought the property from, they do all of it. And then he said to me, and this blew me away, he says, I have never even seen the property. And like, I was amazed. I said, you've never seen the property, you don't have to manage it. I was also really amazed because that sounded like it was an investment right up my alley, because I don't like managing tenants. I don't like looking at properties. I don't like real estate. And it's crazy. People always say, you have 5,000 properties. Yeah, but I've never seen most of them. Right. So really, Keith, for me, the big shift was when my brother told me that concept, and then I started to look into it. And ever since then, I do not care about the market. I don't care about the city. I don't care how far it is. I always now look at what you just said. It's the fundamentals and the team. That's all that matters. That's all I study. So I own thousands of properties. I've never even been to the city. And that's a huge mindset shift for most people. And what I say to people is sometimes, you know, do you have investments in the stock market? Most people say, sure. And then I would say, well, do you go up to Fort McMurray in Canada to see if there's oil in the ground? Right. Or do you go to the gold mine in South America to see if there's gold there? You should have went to Blackberry or Nortel in Canada to their head offices, and maybe you would have invested because you lost all your money. But those are some examples. When I shifted my mind, I didn't have to go see the property anymore. I mean, what the hell do you think a 200-unit apartment building looks like? It's got 200 units in it. I mean, let's look at the numbers.
Absolutely. And it can be helpful to walk the property yourself. But yeah, you just have to learn that you don't absolutely have to do it, because oftentimes you can hire an expert that's really a specialist right there in that local market and leverage their expertise. But yeah, you're absolutely right. You know, a lot of people invest in stocks, and say someone buys Apple stock. Yeah, but that person that lives in Wisconsin and buys Apple stock is not sitting inside the Apple corporate shareholder meetings in Cupertino, California, or wherever they have the shareholder meetings. In fact, they don't even know where those meetings take place or when they are, or even if they did, they wouldn't have much of any leverage in that meeting. And those meetings discuss that investor's own money. But when you invest in real estate, you can get that property management statement every month. It should be transparent. It's all right there. And you just have a much greater degree of control when you don't live in a geography where your real estate's located than if you don't live in a geography where your stock and stock derivative investments are located.
Again, I couldn't agree more with you. I think that hits the nail on the head. So it's a big shift. Again, think of it, you know, why do you physically have to look at the property? And all I say to people is what we really looked at is the numbers. And honestly, I also think sometimes it hurts you. If you're looking for investors anyway, some investors think they know everything about the city they live in. So it's easier to actually sell them on the idea why they should look somewhere else because they're not as familiar with the different cities. So sometimes, in my experience, it's actually easier to sell properties to people that aren't in their backyard.
Yeah, and when you're analyzing things remotely, I think you need to think about what matters. And you really need to think about things in a way where you're not stereotyping, you're not lumping things together. For example, I'll just use an example of one of the best investor advantage cities in all of North America. It is Memphis, Tennessee, where you have a good ratio of rent income to purchase price. And someone might look at Memphis statistics. I don't know if this is true. I'm just using this as an example and say, well, crime is high in Memphis, so I'm not going to invest there. Yeah, well, what part of Memphis are you investing in? When a person lives in their own city and you're in Edmonton, you know there are good and bad parts of that city, but somehow you're willing to extrapolate out all these generalities when it comes to a city other than the one that you live in. There seems to be some human predisposition toward doing that, but you just need to think about your own city in the same terms you think about as another city.
Again, I agree. And Ken McElroy is one of the rich advisors, and I trust him and Ross, his partner, and I bought 5,000 properties with him. And that's what separates the amateurs from the professionals is that fine point of, okay, of course there's crime. There's crime in every city, but I'm not going to buy an apartment building in the heart of the crime area. Just because there's a little area that's bad doesn't mean the rest of the city is bad. And it's that extra mile, that extra due diligence that you do and building that story. That's why I gave those guys, for instance, $100 million to buy properties. We don't worry about, the little blemish here and there because it's irrelevant to our investment 20 miles away.
Right. People really need to parse things down and look at things. And when you do have a local specialist or someone like a Ken McElroy that really analyzes markets, it's not just about crime overall. And you don't just parse that down by geography within a certain metro. Say, for example, there are violent crimes and there are nonviolent crimes. Well, do you think that's useful information before you make a decision? There might be two neighborhoods that have the same crime rate, but one crime rate might be on the upswing while the other is substantially reduced over a number of years because that neighborhood's cleaning itself up. So, you really have to look into the numbers and just be careful about lumping a whole bunch of statistics together. Analyze what they mean. That's not the picture. It's just part of painting a picture when you look at a statistic.
Again, that's very wise. I've never even thought of that detail. And again, usually I hire somebody to do that. I'm more of a bigger picture guy. And I think that's where you have to be careful as well if you're listening to this is I've had some engineers who invested with me years and years ago, and they overanalyze things to the point of where they don't do anything. So, the bottom line is what's the rent? What's the expenses? What's my ROI? And then I go out from there and say, okay, is there crime 3 miles away? Okay, I'm not going to even worry about it. So again, you can analyze things to death. The key is, I think, like you said, let's analyze the city first. Memphis, it's got positive cash flow, and let's go from there. Be aware of these things, but I wouldn't let any small statistic influence my decision on a great deal.
Let's talk big picture about real estate then, because you do a lot of interesting things, Darren. You own cruise ship terminals in the Caribbean. You're an entrepreneur, and you own a number of companies. So why real estate, big picture at all? Why is it worth putting your dollar in real estate as opposed to something else?
Well, the story I shared with you, I bought mutual funds when I was 10 years old, and I have an investment book. I still have it, and it's all my investments I made, and I tracked the ROI back from when I was a kid, and I bought penny stocks. And it seems like when I look at that book, all the paper assets, I lost money. So I just quit doing it. And then the last time I invested money in the stock market, and I shouldn't have, it was 2007, just before the crash, and I invested in companies like Washington Mutual, which don't even exist anymore, and I lost, another $250,000. And ever since then, I've never bought paper. So I've always liked real estate. I study what rich people do, and rich people own businesses typically and real estate. And that's what I stick to now. It provides me good cash flow. I love the leverage aspect of it. I hope there's inflation because I, again, like leverage. And, every month I get cash that's pretty consistent, predictable. And if the market falls apart tomorrow, my asset's not going to go anywhere. So I've always been a big fan of real estate, but I'm not a big fan of, getting my hands dirty and analyzing it. I just like to park my money in it.
Yeah, and sometimes it's difficult to analyze and understand where a real estate return comes from because you're paid so many different ways when you're a real estate investor, and some of these are just really silent phantoms working for you in the background. So when you have that book of investments that you have where you're tracking your ROI, sometimes it's difficult to quantify and even extract some of these numbers like the tax depreciation benefit that you get or the mortgage interest deduction that you benefit from, or probably the one that's more stealth than any is the inflation hedging benefit that you have when you tie up long-term fixed interest rate debt. That's something that is completely overlooked.
It is, and actually I call it the different profit centers in real estate. And I think there's 7 of them, at least what I teach, there's 7 of them. But I also teach people that don't ever show you're a potential investor, probably more than 3, because I've always said this, and I took it from somebody else who taught me this as well. A confused mind doesn't buy. So I want to show them big picture, get them an ROI they can put their teeth into. They can understand 8, 9, 10%. But that's it. I don't get into too many details until they bought a few properties and or they've got the experience to really grasp it. I've just found too many times where people give too much information and then the customer basically is confused. So they find a way to say, no, I don't want to invest because it's too confusing.
That is really interesting. A confused mind doesn't buy. That is really good. Well, Darren, I often talk about how real estate investors have 5 simultaneous profit centers. You mentioned 7, so I'd love for you to describe those. Let's see how you break those down.
Well, again, the 3 that I would teach would be first is cash flow, and I would have people do an ROI on cash flow. Second of all would be the mortgage buy down or principal reduction, and then they obviously realize the tenant pays off the debt. And the third one I then show people is the inflation one. And if you're in a good city that has great fundamentals and you have even a 3% inflation rate on in your property or appreciation, then you're going to have a very good ROI when you add in the first two profit centers. On top of that, you can do forced appreciation because you're going to renovate some of it. You've got depreciation. Those are, a couple more. So I don't know the 7 off the top of my head. I don't have it like right in front of me because I always teach the 3. I don't go more than the 3. But like you said earlier, there's so many tax benefits. But if you show them all to your investor and all they've done is saved money or bought some mutual funds, you're going to confuse them so much. They're going to say, I don't want to do this. They may not say that, but mentally they're saying, I can't handle this.
Yeah, it's almost dizzying all the ways that you make a return as a leveraged cash flowing real estate investor when you tie up long-term fixed interest rate debt. What's interesting is you're paid so many ways. Sometimes you're not even aware of those. But yet when you're a mutual fund investor, you have so many fees that are going ahead and dragging down your return, and you're not even aware of those. So it's like in real estate, the things you're not aware of, oftentimes they actually help you out rather than drag your return down.
I mean, I've raised hundreds of millions of dollars on those principles. Like if you start to watch people who invest in paper, typically mutual funds, I always say this to people. Do you know anybody who all they did in their life was to save money and invest for the long run in mutual funds, for instance, that is rich? And you never have anybody put their hand up because it's almost impossible to do it. That's another reason I'm in real estate, because paper asset class doesn't work for the vast majority of people.
Yep, that's right. I don't think I've ever heard of anyone that I've personally known where it's made them wealthy. You're listening to Get Rich Education. Our guest is Rich Stat Advisor Darren Weeks. More when we come back. I'm your host, Keith Weinhold. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president and chief wealth strategist of Valhalla Wealth. They help busy people build wealth outside of Wall Street by strategically combining their clients' cash flow statements with the financial vehicle of the wealthy, according to the infinite banking concept. If you are interested to learn how to perpetually multiply your wealth, you can access an exclusive webinar at yourownbankingsystem.com. Cash flow real estate investors, if you're looking for a mortgage loan with a company that specializes in investment property loans, it's Ridge Lending Group. They provide income property loans in almost every U.S. state. Ridge has worked with tens of thousands of investors and homeowners all over the country. In fact, with ethics and transparency, they've helped more people realize their dreams through real estate investing than any other mortgage lender in the country. Get started at ridgelendinggroup.com.
This is Profit Boss Radio's Hillary Hendershot. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education with our guest, Rich Stat Advisor Darren Weeks. Darren, you said something really interesting. A confused mind doesn't buy. And, that really ties into capital raising, something that you are an absolute expert at. You as a listener, as a real estate investor out there, you are going to run out of your own money to do deals at some point, and you have a few roads open to you. If you're a busy person, you might just want to go ahead and accumulate liquidity until you can make your next down payment on a turnkey property because you're busy with your job and your life, and you know that real estate's out there working for you. But if you have some more time and you're willing to learn some new skills, you can raise money from other people for your deal. So with that in mind, and that process is called syndication. With that in mind, Darren, I want to ask you and just run this common axiom by you and find out, do you agree with this or do you disagree with this statement right here? It takes money to make money.
No, I don't agree at all. And that's why I guess Robert asked me to write the book, The Art of Raising Capital. So it doesn't take my money to make money, that's for sure.
Right.
It takes an idea. That's all it takes is an idea. If your brain is lazy, then you won't be able to raise capital. But if you're able to think through things, you can raise money. You can use other people's monies and assets, and you can become very wealthy. And if you want, Keith, I'll give you a quick example.
Yeah.
So I'll go through two examples. The latter example is after I already owned, 20 properties, I ran out of money. I then thought to myself, how can I own thousands of properties like Ken McElroy? So it was really simple. I met all kinds of people that would love to own real estate, but they were typically too lazy or they didn't want to get their hands dirty. And they were tired of, the mutual funds ups and downs. And then I also had Ken, who told me it took a lot of effort to raise capital. It's like a full-time job. And he would rather find properties and manage them well than raise money. So I thought to myself, okay, what if I was in the middle? What if I introduced people to Ken who had money? And on my end, I did all the work to aggregate the money the down payment, the equity. So I would take 300 or 400 people. They'd give me $10,000, $15,000 each. I'd add it all up. I'd say, okay, here's $5 million. I'd say to Ken, here's a check for $5 million. Now you can go buy that apartment building. But on both ends, I said to the investors and to Ken, will you guys give me part of the deal for doing this? And they both said yes.
Yeah.
So for no money out of my pocket, I've made millions and millions of dollars by putting investors together with somebody like Ken. So it's just an example that you just have to think differently and provide a service. But I don't go look at the properties. I don't manage them. I don't talk to the investors every day. I just put these two parties together. So that's just one example of how I've done this with no money.
Yeah, so you're effectively a connector there, connecting people's money with the deal. And I think you and I both know, Darren, oftentimes it's even easier to find the money than it is the deal, especially these days with inventory run down in so many markets. But I think that builds stress in some people when they think, if I wanted to turn the corner and raise money from other people for a deal that I identify, I don't know if I'm going to be able to find the money. But oftentimes, like I said, the money is easier to find than the deal. And the other thing is I think that prospective syndicator thinks about, I'm going to be pressuring people to buy something. So just tell us about how you're not really pressuring someone to buy something, or sort of the use of low pressure tactics in order to attract investors to your deal. Tell us about that.
Well, before I went to the big deals with Ken McElroy, I ran out of money, again, after about a dozen properties. I then went to dentist conventions and teachers conventions, and I would just meet people at trade shows. And I would just say to them, for instance, Keith, I can role play a little bit if you want.
Yeah, let's do that.
So if you were walking by my booth and it had a banner, real estate company, and I'd have a box that had, free draw on it, and people would look at me when they walked by, and I just say, hey, Keith, can I take 30 seconds of your time? You'd saunter over.
Sure.
And I'd give them a little bit of a commercial. Keith, my name's Darren Weeks. I'm a professional real estate investor. And for over 25 years, my team and I have bought amazing cash flowing properties in Alaska or Memphis or Canada, pick your spot. And we help people who are tired of the ups and downs of the stock market own real estate that's hands-off real estate, and it produces cash flow on a monthly basis. Does that sound of interest to you, Keith?
That sounds pretty good.
So after that's introduction. Then you just strike up a conversation, and you really try to get a meeting with the other person. And here's the key tip. Whenever I asked the dentist or the teacher, what kind of a return would you be happy with? Never in the history of my entire life have I ever had somebody that I met say more than 10%. Never, because they don't get 10%. So at that point, you start to show them the profit centers in real estate, why you're buying in Memphis, for instance. And I would say something like this. I'd just say, Keith, if I could, and again, you need about an hour in the perfect world after you get to meet them and know them, an hour in the perfect world to show them the benefits of real estate. And I would just say, Keith, if I could show you how to make 8% where you get paid first, exactly the opposite of the banks where they take fees first, would you be okay if anything over 8% we split?
I would. I'd say that sounds pretty good. Of course, I wouldn't as Keith Weinhold, but as your dentist, yeah, that sounds pretty good.
So that's really all it took was when you give the opportunity to own real estate, they have title to it. They can't be, can't be taken away. It can't be wiped out to zero. And you say, listen, I'm going to pay you first. And unless I perform, I get zero. People are going to line up and invest with you. Trust me, because I've done it. So the dentists, the teachers, they're more than happy to give you all the money for the down payment. And they had to sign on the dotted line for the mortgages. So I didn't have to worry about the banks, saying no to me. I didn't have to worry about getting money up front. And as I got more experience, even before I had the person buy with me, I would actually get a fee. I'd get a $5,000 deal fee because the properties were so good. So there's lots of ways to do it. I've done it, whether it was, one-on-one at trade shows. Eventually, I had a staff of 40 people raising hundreds of millions of dollars. And I didn't do any of those deals with the investors, but I've done all the spectrums in between. So trust me, if you're listening, if you're out of money, it's not hard to be the connector at all, because people have money, and there's way more people with money than there are people that are listening to this show that are experts in real estate.
Yeah. Now, I think a common objection of a person that has been an active real estate investor and they want to turn the corner to be a syndicator is maybe they're afraid that they're not qualified, quote unquote, qualified to be a syndicator. Like they have some fear in their mind, like they might not be able to build enough trust and credibility with a dentist to get that dentist to go ahead and invest in their deal. What would you tell the person with that fear?
Well, actually, that's a normal fear. That was me as well. So I had the syndicator company help me. So first of all, it was just I would invite people to dinner, and if they closed them, then I would get paid a fee. And eventually it was like, okay, rather than giving that away, I might as well run those skills myself and do it myself.
Yeah.
So if you find the right syndicator, there's a number of ways you can make money, make this work. The other thing I was going to mention, and it's really, really important, getting back to the no pressure. That's something else I'm very proud of. We never, ever pressure anybody. And I use something, it's called an upfront contract. And almost at every meeting, I'd repeat it. And you could meet somebody 10 times and do 10 deals with them. And I would still always repeat this. Basically, I'd say, Keith, by the way, I'm not a professional salesperson. I'm a professional real estate investor. I took accounting in school, for Pete's sakes. But what I found is I only want to be treated like, you'd want to be treated. And we're going to talk about real estate. I'm hoping that you'll buy some properties because it's good for your portfolio. But at any time during the process, Keith, if you're not comfortable or you want to say no, please don't ever feel like I'm going to be upset with you or my feelings are going to be hurt. If you ever want to say no, you're more than happy to. Hey, let's be friends. Maybe you can refer business to me or come back to me when times are right. But don't ever feel bad if this isn't for you. So you can say no. So Keith, are you comfortable if you're ever not happy just to say no?
Yeah, I feel pretty good about that.
Okay, so now Keith, in your mind and for the listeners, what happened to your mind? When I just said that, what was going through your mind?
What was going through my mind is it just engenders trust and empathy for you. And it makes me feel like, oh, this guy is just a real person and he's just going to be open and communicative during the process because he's looking for my feedback.
Okay, so this is something else you may want to write down if you're a listener. So I said earlier, a confused mind doesn't buy. That's very, very important.
Yeah.
The next one is people only buy from you if they trust you and like you. So people only buy from you if they trust you and like you. So the minute I do that upfront contract where you can say no, the level of trust goes through the roof.
Yeah.
And I'm telling you right now, they're going to invest in you more than the property.
All right. So in this role play, Darren, I'm telling you right now, as the dentist, okay, we're talking about sort of touchy-feely things if we're just meeting each other and having a conversation. But of course, a lot of prudent people, before they really decide to go ahead and wire you the funds for the deal, they're going to go home. They're going to do some research. They're going to look into you. They're going to check out DarrenWeeks.com because that's probably what they'll find in a Google search. Yeah. So in order to build that know, like, and trust factor, how important is it to have that, I'll call it branding a certain way?
It's really important. And again, this discussion we're going through, this usually takes a few months because you're going to get to meet them at the trade show. I gave them a cassette tape. That's how old I am, Keith. And it would outline the program so they would listen to it so I didn't have to explain it to them. They're going to want to meet with them and their spouse. You don't want to meet with them on your own. And, for instance, it's the clothes you wear, the business card you have, the website you have. I remember I bought an old Mercedes just because it looked better than my newer, Dodge Shadow that I bought when I was a student. So all these factors are important and it takes time. People are not going to meet you and give you a check the next day. So all those factors are very important. And if you're not the expert, then it's really important, again, that you hook up with a company that is the expert, that has the team, the experience. You can rely on them more than you.
They say with the passage of time in a relationship, time will either promote you or expose you. Okay. So with the additional touches, you want time to really be on your side. This guy looks the part. He talks the part. And when I do my own independent research, he looks the part that way as well.
Yeah. Very important.
Any final things someone ought to know about raising capital, how to go about doing it, some common mistakes to avoid?
Well, I would say don't ask your rich cousin or uncle first, because you're going to screw it up. Probably you're going to make mistakes. So realize that. So that's why I started doing teacher conventions, because they didn't have as much money as dentists. That's where I made my mistakes. And where I made my money was a year and a half after making mistakes. I went to dentist conventions. That's where I made my money. So it's going to take time. It's a process. But also, I think change your mindset so that you actually think that rather than you profiting from this person investing with you, you're actually helping them out, because you're going to get them better returns, or at least give them some true diversification by getting them into real estate. So think, how can I help this other person? That should be your first and foremost thought. And if they win, then you win. And I think that's a perfect scenario.
And I think that's just a great tip. You as a real estate investor, you might not necessarily want to go to a real estate investing convention if you're looking for capital for your own deal, because maybe a lot of those attendees are looking for capital for their own deals, or they want to invest themselves in their own active deals. Instead, you go to a teacher convention because you're not going to be competing with anyone else for attracting capital. You're really going to stand out.
Well, and even though I've told hundreds of thousands of people, I've gone to teacher conventions, to dentist conventions, I don't know if anybody's ever actually finally went and done that. So, I mean, it's so easy to do this if you just do things nobody else wants to do. But yes, that's why I went to teacher conventions. They typically don't want to get their hands dirty. They have some money and they're available, whereas doctors, you can never get a hold of them. And that's also the same with dentists. They have a lot more time on their hands, so that's why I targeted dentists. So take your target markets and start to get in front of them as much as possible. It might take a few shows before people stop by and say hi to you regularly because they're testing you as well to make sure that you're going to stick with it through the long term.
Well, you're based in Canada, and, Darren, we might have, a couple Canadian guests on the show per year or something like that. I want to ask you, any differences that really stand out between Canadian real estate investing and United States real estate investing? Just anything at all?
Well, the biggest one and the one I love the most is your debt. You guys can lock in for, and you're more the expert, Keith, but 20, 25, 30 years. Typically, our debt, it's a 5-year term. So in 5 years, if the mortgage rate doubles, then your cash flow goes down the toilet. So I love the fact that you guys can lock in for such a long period of time. And that's why I'm thrilled we have 5,000 apartment buildings in the United States.
That's right. This is an advantage that a lot of countries don't have. And that is really my favorite loan for 1 to 4 unit properties, especially that 30-year fixed rate amortizing loan. Boy, a lot of places just don't have it. 3 decades of certainty on the greatest expense that you have associated with your property. It really is incredible. And some people overlook that. Yeah. Well, Darren, what can our listeners do if they want to find out more about you?
Well, I got out of the seminar business. I'm just doing more traditional businesses. You mentioned early in the introduction, I own Black Rifle Coffee. I don't own the United States Black Rifle Coffee. I own the Canadian version of it. That's one thing I do. I've got a wine company, and I just look for investments. I'm one of the guys you'd want to contact because I have money and I'm looking for deals, and I'm getting lazier as I get older. Just Google Darren Weeks, but you won't find a whole lot because I'm basically retiring and just doing my own thing and speaking the odd time throughout the world. But just kind of laying a little bit more low than I used to, Keith.
That's interesting. It's a bit Shark Tank-ish here. So, yeah, if you're a listener that you're looking for someone to invest in your deal, whether that's real estate or a business, maybe you want to look up Darren Weeks. Thanks so much for coming on to the show.
Thanks, Keith. I appreciate it.
Yeah, some interesting takeaways there on how to raise money for real estate deals. Darren goes to dentist or teacher exhibitions. Darren says, keep it simple when you're out there raising capital. Don't even show all the ways that you're paid to your prospective investors because they'll just get confused. And yeah, it is almost dizzying to contemplate all the ways that real estate investors like us are paid. Yes, it really is great. And it sounds like he broke it down into 7 different simultaneous profit centers that real estate investors have. And I guess you probably could approach it that way if you called each individual tax benefit its own profit center, like you called the mortgage interest deduction one and tax depreciation another and tax deferred capital gains another and so on. As you know, I lump all of the tax benefits into one profit center with the way that I explain it in the 5 facets or the 5 dimensions of profit that you have as a real estate investor. And why don't we go ahead and break those down again, those 5, because both novices and experienced investors love to hear this example. With your $20,000 down payment on a $100,000 property, and yes, this is admittedly a heavily simplified example. All right, real estate has an historic appreciation rate of about 6%. Let's just be conservative and use 5% here. After 1 year, that's a $5,000 gain on your 100K property. So that's a 25% return on your down payment because you're leveraged 5 to 1. You know what? For your second profit center, cash flow, let's just say that you have some things go wrong because I talked about how I had some problems earlier in the episode. Let's say you have more maintenance or vacancy than you expected, and you only get a 6% return from cash flow in year 1 in this example. So now we've got a 25% return from leveraged appreciation plus a 6% cash-on-cash return. And then your third profit center is that your year 1 principal pay down by the tenant is another 4 or 5% of your down payment. Let's just call that another 4%. We're being conservative here. We'll call all your tax benefits just another 2% tailwind for you as we're just kind of moving along quickly here and just being conservative. And then finally, the $80,000 that you've borrowed for this $100,000 property, That gets easier to pay back over time as inflation dilutes the weight of your debt, just like it will inevitably erode a saver's purchasing power. Say inflation is 5%, and that is a very realistic number, as we know the government substantially underreports inflation, but you have an 80% loan, an 80K loan from the bank, not the whole 100K, so you're only getting a 4% inflation hedge, not the full 5%. So let's tally up your 5 profit centers. You've got 25% from leverage appreciation, plus 6% from cash flow, plus we said 4% from your tenant-made principal paydown, plus 2% from tax benefits, plus 4% from inflation hedging. And there you have it, a 41% total rate of return as a real estate investor when you directly invest in your own deal. And that was quite conservatively calculated. Yes, that 41%, that is exactly why we do this. That's why we discuss this stuff each week. In fact, the first article that I'm writing as the newest columnist for Forbes is tentatively titled How You Can Profit from Inflation, where I really go in deeper and explore some of this fifth benefit of inflation hedging, that least understood benefit. Yes, we are inflation profiteers, of course, when we tie up that long-term fixed interest rate debt. Back to our guest, Darren Weeks, today. It's interesting to note some of the differences between United States and Canadian real estate investors. In Canada, you can have longer amortizations, but your interest rate is typically going to reset every 5 years if you're a Canadian investor. Here in the United States, of course, we have this incredible deal where we can lock in our long-term fixed interest rate debt for 30 years. Our greatest recurring expense provides you with 3 decades of certainty. And with rates still historically low like they are, I encourage you to get your property tied up sooner rather than later. Interestingly, since there is no tax deferral equivalent to a Section 1031 exchange under Canada's Income Tax Act, that's why Darren still owns that same property that he's owned since he was a university student in 1990 that he described to you, because there would be capital gains tax to pay there if he were to sell. So I'm telling you, the United States has both the investor advantage markets and the tax advantage rule of law for real estate investors. Well, you've got to find it exciting that a rich side advisor says that he has money and he seeks deals. How often do you hear that? So you can go ahead and look him up if you think that you've got something. Of course, we didn't get into discussing it, but if you ever want to pursue aggregating other investors' capital for real estate deals yourself, then there are probably going to be some SEC, Securities and Exchange Commission regulations that you're going to need to abide by. You can't just jump in and do that stuff. So in the meantime, I've got something else interesting to share with you before we go here. Unfortunately, I surely do not have the time to provide you with any sort of direct one-on-one wealth coaching, and I just know that I'm not going to anytime soon. And for years, I haven't known of a competent coach I could refer you to. But you know, that changed a while ago when I met my friend Jerry and learned more about his company and his ethics and his transparency. You're actually provided with one-on-one coaching tailored to you to create wealth and passive income. It's sort of the equivalent of having a GPS guide you into your cash flow goals. And there's none of this emphasis on some life deferral plan garbage where some company is trying to rope you into loser mutual funds that might not even benefit you until you're in your 60s. In fact, my friend Jerry's company has calculated the stock-based returns that some of his incoming clients have received, and they have never met anyone that had a long-term return of as high as 0. Yeah, you heard that right. No return as high as 0. When you consider the way these mutual fund companies calculate ROI, and then you consider the 5 drags of lame stock-based investing, inflation, emotion, taxes, fees, and volatility, no wonder that nobody gets ahead. So wouldn't it be clarifying to you if you had a coach interpret your real rate of return on your stock-based investments, and hopefully you don't have very many of those? That one-on-one service is actually 100% free through Get Rich Education. All you have to do is just indicate your interest at getricheducation.com/coaching. Again, I will not personally be your one-on-one coach, but connect with my friend Jerry's professional service. I'm really impressed with my friend Jerry at getricheducation.com/coaching. Just one programming note here. On an upcoming episode, you're going to hear a new show intro and new show music. That can just be a little bit surprising to hear for you, especially if you're a longtime listener, but it's going to be the same me and the same type of content. Next week, we're going to discuss real estate investing, and we're also going to discuss what it's like to quit your job for passive income. What do you need to do to make sure is in place before you quit your job? Until then, thanks to our guest, Rich Dad Advisor Darren Weeks. Check out getricheducation.com/coaching. That really ought to be quite clarifying for you. I'm your host, Keith Weinhold. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, getricheducation.com.